many, many years ago is that agents don't sell what they don't understand. When I talked to an agent and an agent said, oh, I'm such a big believer in term insurance, that's all I believe in. If you ask them 1 or 2 questions about any permanent product, they don't know the answer. Well, if they're going to be in our business, in our industry, of course they're going to sell what they know, regardless of what the client may or may not be interested in. So all we want to do today is give you a background. We're going to simplify a few things today, which typically is done in 2 separate meetings, but we're combining into one today. But what I want to do today is to give you an overview of some things that will help you to elevate your practice. That's what this hour and 15 minutes is going to be about. So regardless if you're in this business 20 minutes or 20 years, I believe I'm going to show you some things today that are going to have an impact on who you sell and what you sell and why you sell to whom starting tomorrow morning. Okay? So, typically I'm not on a schedule. I am today, so I'm going to move a little bit faster than usual. The overview today, and jot this down, okay, if you would, is I look at the insurance industry as 3 separate entities. Of course, the idea is to protect your client from the unforeseen tragedy. However, here's how I break life insurance down. Number 1, I look at term insurance as living in an apartment. Okay? Number 2, I look at permanent life insurance as living in a home. And permanent life insurance, thank you very much. Great. Here's some pads, guys. Just pass them around to people. So I look at universal life, indexed universal life, and whole life as policies similar to living in a home. And then I look at return of premium, which is a term policy. However, the client gets back cash value at the end of certain periods of time, as the villa, because it's a kind of a crossbreed between being in an apartment and being in a house. Okay? That's all there is. There's variations of these types of products, but you're either living in an apartment, living in a villa, or living in a home. Are we clear so far?
Yeah.
Today, by the way, I'm extremely sensitive, so if I ask a question, somebody please answer. It makes me feel good. And then we can move along, okay? All right, we good so far?
Very good.
All right. Now, also, if I ask you to write, if I say write this down, please write this down because it's important and you'll refer to it in the future. So as I draw this diagram, write this down, okay? And you will have no idea what this is. But as I say, in about 45 minutes, when we're done with the universal life, we're going to start discussing the term a little bit. But I wanted to be sure you understand UL and IUL first. In 1983, universal life was introduced. Not one person on this planet understood universal life. It was designed by some people that realized that it was time to move on from whole life. That whole life was rigid, there was no flexibility to it, and we needed a permanent product with some flexibility. So they came up with this concept called universal life. And what I did is I had to find a way to explain universal life because none of my agents understood it. So, and at that time, in 1983, we were pretty much resigned to agents in Florida and Georgia. We weren't nationwide as we are today. So I came up with this concept, and I drove around to our key agencies in Orlando, in Tampa, in Tallahassee, and I showed them this diagram. And to this day, almost 40 years later, okay, they'll call me up and they'll say, Cary, I showed the UL bucket today and I made a $7,000 sale. Okay? It works. It works. Many, many years later, it worked then and it works now. Don't hesitate to show this bucket to your client. Give him a pencil and he'll tell you what he wants. And as soon as he does that, he's saying, sell me, I'm in. Okay, we clear? Okay, here's how the UL bucket works. Picture this as we say in New York, a pail or a bucket, okay? And we have 2 items going into the bucket, 2 items coming out of the bucket because we have 2 holes at the bottom of the bucket. All right, very simple. This is an IUL policy. And it doesn't matter what company you sell it for. It doesn't matter who you're selling it to. It's not an IUL, I'm sorry. It's a UL policy, okay? IUL works almost identically. We'll get to that in a minute, but I want to show you the universal life first. Okay, so again, we're going to have 2 things going in to the UL bucket, and we're going to have 2 things coming out. We're going to discuss each arrow, and the impact of what we put in and what we take out is going to affect this, which I call the water line. And what makes sense here is that the water line will adjust upwards or downwards based on what? What we put into the bucket, correct?
Yeah.
You put a lot more into the bucket, our water line is going to go up eventually. If you are taking out of your bucket, the negative or the negativity there on the water line will be, it's going to drop. The concept is the higher the water line, the better. Does anybody know what I'm using the word water line for in this example?
The cash accumulation.
Money, cash accumulation. Correct, good. It's one of the smartest classes we've had so far. It's terrific, and I'm only doing this 38 years. Okay, so let's look individually at what's going into our bucket and what's going out. Give me a show of hands. Everybody having fun so far?
Yeah.
Great. So I can move on. Okay, you didn't come for the bagel and then ready to go. All right, so what's going into the bucket? Number 1, first and foremost, is I hate the word premium. If you learn nothing from me today, okay, never use the word premium. It's a negative connotation. Clients hate it, I hate it. I use the word, say it again?
Contribution.
Exactly. You sure nobody's been in this class before? Contribution. So client contributions do what? They go into the bucket. What is the impact of contributions on the water line?
Increases.
Go up,
Yeah.
right? Okay. So let's say you now have a client who's putting in $50 a month, $50 a month, $50 a month into his bucket. And now all of a sudden, it's December, and he gets a very nice Christmas bonus. After he buys the kids presents and his wife, they go on a nice vacation, he has $2,000 left over from his bonus, okay? Well, guess what? He can take that $2,000 bonus and do what with it if the bills are paid, the kids have their gifts and they come back from a nice vacation. If he doesn't have anything else to buy or anything else to do with the money, it's kind of extra money, he can do what?
Put it in.
Boom, right into the bucket. And again, the impact of that Christmas bonus on the bucket is boom, increasing the cash value.
So,
Do me one favor, Elizabeth. Of course, we're on kind of a schedule.
Yeah.
Let's wait to the end to add.
Okay.
But I suggest very strongly, jot it down so you don't
okay,
forget. Okay? So now we go in January and he makes his $50 contribution. But now, uh-oh, things are getting a little slow at work. And he's temporarily laid off. He cannot make his contribution that month. What's the impact of that on the water line? Right? If nothing is going in, the negative impact of that will be a reduced water line. So he's unable to make his contribution for 3 months, and then great news, the minimal recession is over, and now he's back to be able to put the $50 a month back in to the bucket. Incidentally, most agents don't know this. Any universal life with any company, the name of it is exactly the same. It's called, for a reason, and we'll talk about it, this product is called, jot this down. If you have to call me tomorrow and ask me a question, there's a charge. Flexible premium adjustable life. And I don't care if you bought this, if your client buys this product from AIG, from Lincoln, from Protective, from Allianz, that's what it's going to say on the front page of the policy. Now let's analyze the name. Adjustable premium, flexible premium adjustable life. That means that the premium or the contribution is what? Flexible. It's not rigid. Therefore, we can do 50, 50, 50, 2,000, and then 0 without this policy lapsing. Are we clear on that?
Yeah.
That's the flexible premium portion of the name of the product. We're going to talk about the adjustable life in a minute. Are we clear so far? Are we good?
yeah.
Okay, if you have any questions, jot them down, please. So, number one is the first item that goes in to the bucket. We good? Who controls what goes in to the bucket?
We do.
Who's we?
The owner.
Clients.
Policyholder. Exactly. So, that's contribution. Number two, of what goes in to the bucket. Anybody ever hear the word interest? The second item that goes into the bucket is interest. Who controls the interest dollars that go into your bucket?
The company.
The company, exactly. Does the policyholder have anything to do with the interest that goes into his bucket?
No.
No. When you see the word interest going into the bucket, keep two words in mind. Jot it down. There's guaranteed interest, and there's projected interest. The guaranteed interest is the interest rate that the company promises to put into your bucket every single month or year, whatever it may be. for life, minimum. So let's say Lincoln's guaranteed interest rate is 2%. On the front sheet of every policy, it says, Lincoln Life Insurance Company, guaranteed interest rate, 2%. No matter what happens to the economy out there, no matter what happens to the stock market, the Hang Seng, whatever indexes you look at, they must pay a 2% interest based on what's in your bucket. Are we clear? The other interest rate that they use in the policy is called the projected interest rate. Anybody ever hear of that? Okay. So the projected interest rate is the interest rate that they're actually paying based on what's going on in the real world. So if right now they're paying 3.5%, that means this number is a percentage, or not a percentage, but whatever they're making with their investments, they want to earn a certain amount of money on their investments, and they put the difference into everybody's bucket. So if Lincoln is happy making 10% on their money, all right, and they're making 13.5, they're going to keep 10 on their investments, and they're going to put 3.5 into the bucket. But they can't pay less than what? 2. Now, I'm in an extremely sporty mood today. So what I'm going to do, I happen to have, it's been a good month, I happen to have $1. And you can win this $1. Don't get too excited now, okay? I'm going to go around the room and I'm going to ask, in 1983, what do you think the projected interest rate was when universal life was introduced? What do you think the interest rate was, projected interest rate? Now it's about 3.5, okay? Keep that in mind. Janelle? 1%. 1%, okay? Janelle, 1%. Scott?
6.
I was going to say, I agree, I'm just going to say 6
Elizabeth?
too.
That's cheating, Elizabeth.
7 then.
This is like, you can do like, let's make a deal, you can say 6.5,
Say 7, it's fine.
okay? This is 1983. Projected interest rate of the first universal life.
I'm saying 2%.
2%. Okay? Come on, Scott.
9%.
I think it's
I think it's 5.
5? I just want to say, if any of my employees win, you don't get the money. Janelle? Jessica?
I'll go 8.
8. And Ron?
1.5.
Okay. I can honestly say this is the worst collection I have ever seen
It's probably 12.
in 40 years of classes.
What is
It's like
it?
20%.
I need to know.
The winning number, when UL was introduced, the projected interest rate,
Wow.
16.5%.
Oh my God.
Who said 9? Scott, you're going away with more than you came with. Better than a bagel.
Wow.
16.5% interest. Do you think that had a pretty nice impact on the waterline? Okay? All right, let's move on. Now, we know what goes in. We know what goes in. Controlled completely by the carrier, controlled completely by the client. Are we good so far? Give me a shake of the head.
Yes.
Okay, Elizabeth, you're not shaking.
Yes.
Okay. All right. Let's look at what goes out of the bucket. Let's look at dollars that come out of the bucket. Okay. These dollars are called fixed expenses. The insurance company charges each bucket a certain amount of money on a monthly basis to administer this account, to basically take care of everything. It's not a lot of money. It's, in some cases, it's $4 a month, it's $6 a month, it's $8 a month, whatever it may be. But it's fixed contractually in the contract. They can't say, wow, you got, your water line is really going sky high. We're gonna nail you a little bit over here. Okay? No. Once it's fixed in the contract, they cannot change it. Boom, period, regardless of the economy, regardless of everything. Simple. Those are dollars that come out every month. So far, we haven't mentioned one word regarding the bucket. Anybody, any word come into mind that we haven't discussed yet, that we're going to discuss right now?
Loans.
Nope.
Cash value?
Good guess. Nope. One word we have not mentioned that makes this bucket unique. The word we haven't mentioned yet is insurance. Protection, coverage, right? This is a life insurance policy. We haven't discussed that yet. Correct? Okay. Let's look at the final opening, the final hole in the bucket. This is cool. This is what makes universal life distinct, and I love it. By the way, this opening in the bucket where the dollars come out of is fixed. There is no flexibility. Once this opening is set by the company, there are no less, no more dollars that can come out of the bucket from that opening at the bottom of the bucket. Are we clear? This is fixed, it's rigid, which is good for the policyholder, correct? Okay. Now, this is the best part of the bucket. This opening right here that goes from here to here, the dollars that come out of that opening are the dollars that protect our body. This opening makes this concept a life insurance policy. As an example, if I am a male, 35 years old, and I have a need for $100,000 of life insurance, a certain number of dollars are going to come out of that opening to do what? Give me the protection I need for $100,000 of coverage, 35 years old. These dollars that come out of the bucket, and how do those dollars impact the water line?
Brings it down.
Right, are called, write this down, anybody ever heard of the word mortality charges? And again, I just want to say, we're not going over every detail. You're not going to become Albert Einsteins when it comes to every single detail. We have 6 folks here that are brokerage managers, they're marketers, Ron being one of them. Call if you have specific questions. The idea is, what I want you to do is walk away today with a simplified overview so you understand what UL is. Are we clear? Any specific technical questions, call our marketing department. Okay? We can't, we'd be here 3 days if we addressed every single minutia detail. Okay, so the mortality charges are the dollars that come out of this bucket to protect us. Let's say I am a male, 50, and I'm married, and I have kids in college, and I've got a big fancy house, and a Lamborghini, and here and there, and all these expenses, and I need $1 million of coverage. Well, I'm a little bit older than this man, who's 35. He only needs $100,000. I need $1 million of protection if I die. Do you think more dollars will come out of my bucket, or less dollars will come out of my bucket to have that policy?
More.
More. Number one, because I'm older, and number two, because the amount of protection that I am looking for is higher than here. Now, let's say that's my life at 50. Let's say my life at 55 has changed. I'm divorced. My kids are out of school. I now drive a Chevy. The Lamborghini is gone. My wife has it. Okay? I now have a need for $25,000 to be buried. Who the hell needs $1 million of coverage now? For who? For what? I don't have a penny left in the bank. My wife has it all. So what can I do? I can call Lincoln or AIG or Protective and say, hey guys, narrow my opening, make it smaller so fewer dollars will come out to protect my body, because I don't need as many dollars coming out to give me $1 million of coverage. Now I only need enough dollars coming out to give me $25,000 of coverage. So what does the insurance company do? What's the impact? What's the impact of fewer dollars coming out of the bucket on the waterline?
It goes up.
Exactly. Everybody see it goes up because fewer dollars are now coming out.
It conserves it.
Correct. The money is here. It's not coming out of that opening. So the key here is that this opening here, that may start like that, where so many dollars are coming out for the $1 million, can be what?
Yes.
Narrowed. Correct. Good. Excellent. However, everybody gets that point. What happens if I go from just the opposite? I have a $25,000 policy, I'm a single guy, I'm interested in a nice burial. Now I find a nice woman. She may have kids from a prior marriage. And now I'm making more money. She now is bringing more money into the family. I have now a larger need for life insurance than the $25,000 I had 5 years ago. My whole life is different. I have responsibilities. Can I call Lincoln and say, hey guys, I've been a good policyholder for quite a while. Do me a favor. It's Cary. Do me a favor. I know you guys. Just open me up a little bit so more dollars can come out to give me $1 million of protection from the $25,000. Think they'll do it for me? Think about it.
Yeah.
Because I'm a nice guy.
Yeah.
They won't.
No,
Absolutely not. Why the devil should they take dollars out of here and give me $1 million of coverage because I'm a nice guy?
You have to buy additional.
Guess what they're going to do? Guess what they're going to do? They're going to say, Cary, you've been a good policyholder for a long time, but you know what? We're going to set up a physical for you, and we're going to have to see some of that blood, and we're going to have to see some of that urine, and we're going to have to take a look at an EKG, and we're going to have to be sure that you're in good health. What if I have terminal cancer and I tell them to open up the opening to give me more protection. What have they just done? They took out a few dollars, and now they're gonna have to pay $1 million death benefit? And they don't know if I'm healthy or not? Oh, you with me? So the idea is, this opening is flexible, but you can narrow it automatically and reduce coverage. Your client can reduce coverage if they want to, just by writing a note to the company, or having you as their agent request that they lower the coverage, and you fill out a form. Can you ask the company to increase coverage because you now need $1 million of coverage? Hell no. You have to do this. It's called, write it down,
Sure.
proving insurability. You have to show the company that you are worthy of increased coverage. You do not have to show the company that you want less coverage. They will narrow your opening for you automatically. How do you like that? Bet you didn't know that, did you, Scott? Did you? You can admit it. So again, the point is, and incidentally, what we just described is the second part of the name of this product. Flexible premium, remember? Adjustable life. This opening is flexible. It's adjustable
In one direction.
in one direction. But it's flexible in both directions if you prove insurability and prove to the company you're worthy of it being expanded, so more dollars can come out to protect you.
What if you're not?
If you're not, they will not expand the opening. Do you know how many people try to prove insurability, take a paramed exam, and realize their hemoglobin A1C is 11.2 and they're walking around with diabetes and don't know it? Do you think that Protective Life is going to say, oh sure, let's give you another $1 million of coverage. We'll just take a few bucks out of your bucket and, we'll do that. We're nice guys too. No. Are we clear? Is this making sense? Okay. How are we doing time-wise?
9:15.
15 minutes left.
No, we didn't start exactly 8:30.
It's a half hour.
Okay.
Give or take.
Hey, I pay,
You're a nice guy.
I pay the mortgage here. Now, how many, by a show of hands, in your homes, I didn't ask the question. Oh, I'm sorry. How many of you, by a show of hands, have at least one sink? Are you proud of that? You're not shaking, you're not? Okay, hopefully we have one sink. If you have a sink in your house, did you ever hear this noise? Okay? I'm not insane. Okay? I'm going to relate that noise to universal life. Believe it or not. You ready?
Okay.
You see that? What do we call that?
What a night.
Which is synonymous for what?
Cash value.
Cash value. Okay. What happens if our policyholder is laid off for more than 3 months, like in our example here? What happens if the company starts reducing the interest rate because the economy stinks and we're in a recession from 3.5% or 4%, which it is now, to the guarantee of 2%? What happens to the water line? Well, not yet. Not yet. What happens, what's the net effect on the water line? Right. Now, picture the water line dropping Oh, we have someone else joining us. Okay. Hello.
Thank you.
Are you Tessa?
Yes.
Hi,
So sorry.
welcome. If you
Thank
could
you.
go around this way,
Yeah.
there's a chair in the back.
Sure.
You know, Tessa, I normally don't let people in when they're more than 15 minutes late, but yeah, it's fine. Here, let me get this out. Let's make believe we went to the guaranteed interest rate. Let's make believe our client is laid off and he can't put more contribution into the bucket. The water line is dropping. Not good. Not good, not good. Here's the deal. At all times, the water line must be above these two openings, or your policy will make that noise. Once your water line gets dangerously close to not being able to cover the expenses that are coming out of both openings, you've all heard the word before, your policy is going to, you got it, kids, lapse. And when a policy lapses, it makes a noise. What's the noise? Thank you. Did we apply the noise to universal life? Yes, we did. So that's not good. And right before the water line goes down that far, your client will get a number of notifications from Lincoln and say, hey, your water line is dangerously close to not being able, right? Not being able to allow the dollars to come out of both openings. So what can the policyholder do to increase the water line so that it's not dangerously close to lapsing?
Contribute more money.
Talk to me.
Contribute more money.
Exactly. Number one, contribute more money. And there's one other thing that's not the definite answer, but it's a Band-Aid on the cut.
Lower the face amount.
Perfect. Perfect. Say what? Close my opening, so less dollars come out, and I will have less coverage. The only problem with that is what?
Yeah.
If he gets a better job or gets more money,
He has to prove
Insurability.
insurability.
perfect. He has to prove insurability. Again, he did the first time. Are we clear? Does that make sense?
Yep.
Now, before we talk a few minutes about term, and then we'll have questions, there is a policy that is, by the way, the only difference between what I just showed you, this is universal life, the only difference between this diagram and indexed universal life, right? The only difference. Who controls the interest rate in universal life?
The company.
Company. Okay? If you buy an indexed universal life, you tell the company how to invest your contribution. So you tell the company, I want to spend 40% of my premium in NASDAQ. I want to spend 20% of my premium in the Chinese stock market, the Hang Seng. I want to spend another 10% of my premium in the S&P. So the company will invest your contribution how you ask them to. And the net result of that could be they will credit your bucket a higher interest rate than what they're crediting everybody else with universal life. My only suggestion is, it sounds marvelous, I wouldn't discuss indexed universal life and investing one's contribution with anyone that wasn't fairly knowledgeable in the stock market and in investment practices. You don't need a special license to sell indexed UL, but I wouldn't sell it to someone who has no idea how they want to invest their contribution, because they stand to not make the projected interest rate that they would earn with regular universal life. Is that clear? There is nothing different other than IUL and UL, other than there's a page on the life insurance application telling the company how to invest your contribution. Okay, did that simplify it a little bit for you? Okay, let me tell you one other thing, then we'll jump to term for a few minutes. Is this making sense?
Yes.
Okay, am I going to get my license renewed? Yeah. There is a product that has come out since Universal Life. It's called, write this down, this is another arrow in your quiver to show your clients. GUL, Guaranteed Universal Life. Does it mean that if you had a pacemaker just put in and you're still in the hospital, that the company must give you a policy? No. It's a universal life with no flexibility. What it's guaranteed to do is keep, write this down, keep the waterline above both openings at all times. If you pay that premium, let me explain. If you are a female 40 and you buy a GUL, there is no cash accumulation, or minimal. There is none. Think of a GUL as a policy for someone who does not want cash accumulation. No waterline. Okay? So think of a GUL as a term policy. But guess to what age you can sell the GUL to and it will not go away, it will not lapse. If you pay the premium, let's say the premium is $94.10. If you miss a premium, what are you going to hear? If you pay $94.10, you can guarantee, you tell the computer how long you want that policy guaranteed for. You can go today up to age 126 years old with some companies. And if you pay that $94.10 and never miss a premium payment, the coverage will be in force and you'll never hear the slurpy noise. The waterline will always be on top of the two openings. Guaranteed universal life. That's a product for somebody who says, why do I have to pay more? I don't need a waterline. I'm only interested in coverage. Is that clear? GUL. You can call us or run your own illustrations. You can run it to any age up to 126. You can say to a client, well, how long will you be comfortable knowing that you have coverage that will never lapse? I say, I'll go to, we run most illustrations to age 100. So that premium may be $84.10 as compared to $94 something. See what I'm saying? Okay? So you adjust the premium to indicate how long that policy will last. But there's no, you don't put in Christmas bonuses, right? Because they don't want cash accumulation. And you don't, there is no missing payments. Got to pay it. And if you do, you've got coverage for as long as you asked your agent for it. We get weird requests. I want coverage lasting to age 97. Well, why? Well, I don't know. That's what the agent asked us to run a quote for, so we'll do it.
What happens if you miss the payment or something like that?
It could, well, some companies you can make it up,
Okay.
but I wouldn't even sell a GUL telling the client that he can miss payments.
Okay.
I would sell the GUL that this is a policy designed to be guaranteed for as long as you ask for it. I call it term on steroids. No cash, just keep going, baby. Now, one other thing about UL, and then we'll go to term. When you call and ask us for illustrations, or you run them in your office, there's 3 factors in order for you to run an illustration. Okay, very important. The first one is the contribution. The second one is the death benefit. And the third one is where the water line, where the client wants the water line to be. There's 3 factors you have to tell the computer 2 out of 3. Here's how it works. Hey, Andrew, I need you to run an illustration for me. I have a client who wants to put in $100 a month. Number 1. He wants $100,000 of death benefit. That's number 2. So what's the computer going to solve for? Number 3, which is where the cash value is going to be at 65 years old if he's 40. Or what's the cash value going to be at age 100? See what I'm saying? The computer will solve for what the cash value is at a certain age. If you give it the contribution and the death benefit, the computer solves for the cash value. We clear? You may come across another client that says, you know what? I want $500,000 of cash value at age 90. So let's say his water line would be over here, okay? $500,000 of cash value. And I want $1 million of death benefit. What is the computer solving for?
Premium?
I hate the word premium.
Contribution.
The contribution. What's it going to take to give that individual $500,000 of cash at age 90 and $1 million of death benefit? Let's say the computer will solve $209.14. That's the second way of running illustrations. There's 3: contribution, death benefit, cash value at a certain age. The third way is the individual who couldn't care less about what his death benefit is. He says, I got $200 a month to spend. I want $250,000 when I retire. Tell the computer to solve for the death benefit, which could wind up being $219,806 of death benefit. So you got to know 2 out of the 3 to run an illustration. Clear?
Yeah.
Clear? Come on,
Yes.
I'm sensitive.
Yep, yep.
Louder, louder, clear?
Yes.
Okay. Tessa, just because you're late, I still want to hear you. Okay.
Clear.
All right. If anybody would like, I'll be more than happy to sign this for you. In fact, I told you, you've done this before, right? And I told you you'd understand this an hour ago, right? All right. And again, if you have questions, let me spend a few minutes on term and then we can ask questions. Oscar, if you're good with that. Term insurance, like I said, is nothing more than renting an apartment. And I'm going to teach you something, and I don't care how long you're in the business, I'm going to teach you 1 or 2 things right now that you don't know about term insurance. And most agents say to me, are you kidding me? When I finished the course, to get my insurance license 17 years ago, I knew that about term insurance. They asked that on the test. Well, guess what? You don't know. And I'm going to tell it to you. Let's say I'm 40 years old. I wish. There's an apartment complex in Coral Springs that's beautiful, and say, I want to live there. I approach the landlord, and I say, I want to move into a two-bedroom condo or apartment right here. He says, great. We're going to run a credit check, and we're going to do this, and we're going to do that. And if you qualify, you can move into my apartment. Great. I love it. I can buy, or I can lease for 1, 5, 10, 15, 20, 25, 30, 35, or 40-year leases. The landlord is making that available to me. Incidentally, regarding term insurance, Banner Life just introduced 35 and 40-year term policies. Okay? So I believe they're the only company right now that has that option. But anyway, I go to the landlord and I say, you know what? I love this place. Sign me up for a 30-year lease. Okay? And he says, great. And they do the inspection report on me, and they make sure I'm not a felon, and I'm making a good living, and on and on. And the landlord comes to me and says, Cary, great news. You're in, buddy. Now I start, what do I have to do for the landlord to not evict me? Just make my rent payment. So here I'm going along, month after month, everything is fine. I love my apartment. I love the neighbors, I love the pool, I love the tennis courts, I love everything about this place. And as long as I continue to make my payment, which the landlord agrees not to raise, okay, he has to do what for me? Keep it nice. If there's a leak, they fix it. If I need new carpeting, they repaint, whatever they may need to keep me happy. And I have to make my payment to the landlord. And everything is cool. Okay? Now, let's say I love it and I stay 30 years. And at the end of 30 years, when I'm 70, I still love it. So I go to the landlord and I say, hey, it's 30 years later, can I stay? He says, sure. But when you originally took it, the cost to maintain the pool is 3 times as high. The cost to cut the grass, the cost for this, for that, for this. So you were paying $500 a month for rent. If you want to stay another year, Cary, it's going to go to $1,500 a month to go to 71 years, for my age of 71. I can make the determination if I want to stay or not. Do I love it? Do I want to find something else that's less money? Are we clear? This is term insurance. This is a 30-year policy. As long as I pay the insurance company every month or every 6 months or every quarter or once a year, whatever the premium is, if I die within that 30-year period, they must pay my beneficiary. Everybody knows that part, correct?
Yeah.
Correct?
Yeah.
Okay. Thank you. Okay. Now, if, however, I decide to keep this policy and stay another year and pay the $1,500 a month, why do you think I would keep the policy and pay $1,500 a month instead of $500 for my $100,000 life insurance policy? Why would I triple my premium payment?
You can afford it.
Hmm?
You can afford it.
I could be William Trump, or Donald Trump, but why the heck would I want to pay AIG $1,500 a month when I've been paying them $500 a month?
You're sick.
Ah! Thank you. I'm sick. Can I call Allianz and say, hey, I'm 70 years old. Sell me a new $100,000 policy. Yeah, it's going to be higher than the 500 because I was 40 when I took out that policy, but let's say it's going to be 800 at age 70 if I'm pretty healthy. That's the only reason I would keep that policy if I was uninsurable, if I was sick, if I couldn't buy a new policy. We clear? Okay? And guess what? If I didn't die between 70 and 71, and I say, I'll pay one more year, because my family wants to get the death benefit, okay, because I paid for 31 years now, all right? What do you think the premium might be between age 71 and 72? Who thinks it's $1,500 a month? Who thinks it's $3,200 a month? I do, because that's about what it is. We have heard horror stories from agents where people were in hospice, and it's terrible, but were supposed to die before the end of the term and did not. I have an agent in Atlanta, Georgia that called me up whose mother-in-law was deathly ill. It was a $750,000 policy. He loved his wife's mom. She was like, I don't know, mid-80s or something, and terminally ill for years. In hospice for months. And every month he would call me up and like, you know, and I would say, well, Dick, what do you want me to do? And he paid the premium. She eventually passed away. But I'm just saying, this is the problem with term insurance. You're renting, and eventually the rent is going to go up dramatically. Okay? Now, who knows what this word is when you go year to year where the premium keeps increasing? Most agents raise their hand and they give me the wrong word. Okay? You know it. That concept of going year to year at the end of the policy is called, you are exercising the policy is renewable. You can continue to renew it at the end of the duration that you commit to on a month-by-month basis. I'm not aware of a term policy that does not have that feature. Policies are renewable. Okay, are we clear? The person does not have to give it up at the end of the term period, but guess what? He's going to pay through the nose. Clear? That's a point that I would make to a client. Scare them. Term is great. Rent right now. But eventually, I want to get you into a home. Are we clear?
Yeah.
Now, let's say the tenant is now, there's another word I want you to learn, is now 45. He says, man, I hate this place. I hate my neighbors. The pool is always green, moldy. Every time I call maintenance for a leaky toilet, they don't come. I want to get out of here as quick as possible. I'm now 45 years old. When I bought my term policy, I was in very, very good health. So I got the preferred classification. I got great rates. Now I'm 45. I want to get out of the term policy. You call your agent, and you say, I want out of the term. I want to buy a house. I want to buy a universal life. Well, he said, well, wait a second. How's your health? Right off the bat, you know what I just said. He doesn't know what he's talking about. Because if the agent says to this client, when he says, I want to get out of the term and into a UL, how's your health? He doesn't know what he's talking about. Because his health, he could have terminal cancer. But the company must give him a universal life. What? Yes. Because this option, when he wants to get out of the apartment and into a home, is called, thank you. We should do this together. You want to go on the road? The word, and again, most agents say, oh, I know what that is, I heard of that. Well, guess what? You may have heard of it, but most agents don't know what it is. It means the policyholder can get out of the term into a universal life without proving insurability. There is no medical, there is no, you just say, I want out of the term. What a beautiful thing. When the client, he may not have been able to afford a universal life at 40. Maybe at 45, he got a couple of nice raises along the way. If he's in business himself, it's starting to do well. He can afford a home, a UL, and he can afford to start building cash. I look at a term policy as an agent. I would tell each of you, every time you sell a term, you must go back every year and discuss convertibility with your client. You must discuss getting out of the apartment and getting a home. For his sake, and we're almost done, one point that'll make it a little bit more interesting for you as to why you should see your client about converting this term policy. Any agent, and I don't know if you know this, any agent can convert a term policy and get brand new full commission on the converted universal life policy. And most agents don't know. You don't have to be the agent who wrote the term to get the commission on the new universal life. You know how many calls I get in a week? Cary, how could you do this to me? I've known you 40 years. Okay, what? What did I do? I sold a guy this term policy 17 years ago, and now somebody converted him. And he told me he's one of your, the client tells me, I don't know, your name came up in conversation. How could you allow that to happen?
You didn't do it.
Excuse me, where were you 17 times when you should have seen your client about discussing the possibility of converting the term insurance? It's your responsibility. So you can be the agent who makes the term commission, or you can be the agent that makes the universal life commission, which is typically $2,000 or $3,000. Or you can be the agent who makes both commissions, the term and the UL. My advice to you, and we'll end here, is that if you're going to put a term policyholder on the books, make sure you maintain a relationship with him, get referrals, okay? He will grow. I've seen stories over the years. I'm in this business since I'm 21 years old, okay? I'm now 48. I have seen stories of people's, agents' lives changing because they stuck with clients, were there to serve them and help them every way that they could. And you develop a loyalty with a client. As his life changes, hopefully for the better, yours does as well, And I've seen some referrals in situations like this that are mind-blowing. Okay, so, how are we time? Are we okay, Oscar, for a question or two? Okay? And if anybody does have a question now that you want to ask, by all means, on either one of the topics, or you can save them and we'll talk about it later. If no one does, I thank you all so much. I hope you got a couple of
Can I ask one?
points. Yes, please.
Can you convert a GUL to an index universal?
No,
life?
GUL is a permanent product.
The index is also permanent?
Yes, you can only convert term to permanent.
Oh,
Now, you may be, we'll have to, that's a good question, and we'll have to call the company to see if you, but it's not a conversion, it's basically changing a policy. This is the definition of a conversion,
okay,
term to something permanent.
okay.
No, anything permanent, okay.
Anything permanent that that company offers, it's
Okay.
got to be the same
Has
company
the same company.
that you wrote the term insurance with.
Oh, okay.
Correct.
Okay.
Okay?
Most of them are convertible to age 70 now.
Yes. Yes. Or the end of the, if you're 40,
70.
well, if you're 40 and you buy a 20-year term policy,
Yeah.
most of them are typically convertible for the, until the end of the term policy.
Question on the IUL. When you said that you can make additional deposit, let's say at the end of the year, you get a bonus, and you can do that once a year, twice a year, every quarter?
As long as you don't go above the guideline or it becomes a taxable situation, and you can stay within the TEFRA guideline. And yes, you can do that to have a positive impact on your water line, your cash value.
One other one. You talked about the exits on the universal life,
The exits,
the mortality,
oh,
The two holes.
the two holes.
the openings.
The openings. When you're adjusting the
Mortality
the
charges?
mortality charges.
Again, you
Can
can
you-
shrink it automatically, you can't expand it automatically.
Right. At any point, can you also adjust the contribution?
Yes, you can adjust this at any time, going in. As far as adjusting the opening, you can decrease it at any time.
When you decrease it or expand it, when you decrease it, can you change the contribution?
Yes.
Can you
When
reduce
has-
the contribution?
Oh,
or-
yeah.
Okay.
Yeah.
It
Again,
has that flexibility.
What's the
you're saying.
goal here? You want your client to have a water line and a bucket doing what he wants it to do, or she wants it to do. Do you want, some clients want a water line, whoa, I want $1 million when I'm 75 years old. Or, I'm not willing to put in contribution so that I have $1 million. I just want my cash value to cover the two openings. It's up to what the client wants.
Yeah.
And to me, that's great conversation, where you discuss this with a client. What do you want? You know, I'm not saying take an hour and have this discussion with a client, you'll be out in the hall. But I'm just saying, this is something that you can discuss. What do you want for you, your wife, and your children? Do you want cash value accumulation? Or do you want your policy to be, do you want death protection and retirement? That's a death benefit and a high water line.
One more.
Yes.
On the index universal life, where you said that we control the interest rate, that interest rate is not guaranteed at all?
There is a guarantee,
Okay.
but it can go higher or lower. My point is, it can go higher than the projected interest rate, but it can never, with IUL, it can never go below the guarantee. There is a guarantee
Okay.
in the indexed UL policy too. We don't sell variable products, but from what I understand, there's no guarantee in a variable universal life. So, but, well, as far as the IUL goes, just be careful of who you sell it to. Make sure they have a good understanding, and they say, well, here's how I want to invest. my $300 a month contribution. Because again, part of the application is a separate sheet of paper where you tell the company how to invest this client's contribution. That's the only difference. I'm conservative, okay? I prefer this. I never wanted, as an agent, I never wanted a client to say to me, well, you made this happen. You know, this is why I'm suffering now. You know what? Here's what I suggest. If you want to do something otherwise, by all means. But for the right client, we sell a ton. We sell millions of dollars of IUL, of premium contribution. Okay? You guys have been a pleasure. I thank you so much. And if you have any questions at all about any illustrations or anything, like I say, the marketing department is here from 9 a.m. to many nights, 8 o'clock at night. So, thank you.
Thank you.
Thank you.